More on today's earnings and what investors need to know for the rest of the week. Let's bring in Greg Branch. She's a partner at 1847 Financial, and Mike Santoli, CNBC senior market commentator. Good to speak to you both. Mike, we've got a smattering of earnings so far, and it's been quite a mixed bag, and no surprise, many companies are still, withholding guidance for the rest of the year. So really, this is all sort of no surprise here for the markets. Nothing new.
Not much new. The market has essentially written off this quarter in terms of really being any progress toward the longer-term earnings targets. I mean, just for an example, McDonald's missing slightly, 66 cents. Was it going to be 71 cents? On February 28th, the projection for this quarter was 217, right? So the market has said McDonald's, yes, it's retaining market share. It's going to be fine. Most companies are in this position of getting the benefit of the doubt that they're not really backsliding unless they're in the travel area. However, McDonald's also is an instrument where you can get 2.5% dividend yield. So I think that push-pull is what's keeping the broad market supported, along with, of course, the big growth stocks that are beneficiaries of this environment. So I think it's pretty much a steady state during this earnings season where the 12-month forward estimates in aggregate are starting to curl higher, and that's giving a little bit of reassurance that this is a kind of hunker down, weather the storm, and things are turning for the better down the road.
With all that said, Greg, how do you go through earnings season, and what sorts of questions do you want answered when you're on a company conference call if you know that the company is going to stay away from giving guidance for the rest of the year and things, as Mike had mentioned, are fairly status quo at this point in the recovery off the bottoms?
Yeah, let's talk about two of the names you just mentioned. And so for McDonald's, what we want to see from them is to reaffirm their financial strength and assure investors that the dividend is safe throughout the back of the year. We expected weakness in Europe, where closures have been more significant, where traffic is down, where reopenings have been less widespread than they've been here. So that's no surprise. In addition, the participants in the sector usually give a mid-quarter update, and so we generally have a directional feel for where those same-store sales are going to be. On the positive end, hearing them say that they're going to invest more in digital and delivery is a plus. Generally, those are the names that have been rewarded in this sector, particularly the pizza names, as that's provided some support as people have shifted to stay at home.
You like McDonald's, it sounds like, Greg.
I think that there are others in the group that are more attractive. It's hard to argue with their financial strength and their resiliency and their ability to power through, particularly if we see a resurgence or a second wave.
Right. Which other names do you like better?
I think the pizza names are still the place to really look here. Again, they're among the strongest in terms of those two areas where investors have really rewarded, and that's in the delivery and in the digital sales. Chipotle is a strong name in those two areas as well. And so, we've seen in this market that investors are flocking to areas of strength, and those in this sector are by far two of the main things that investors have concentrated on.
They are the ones also poised to best deal with this pandemic environment for longer, Mike Santoli, and that may be the theme that we could see emerge also in the earnings season in terms of trends. And the companies that are willing to actually go out on a limb and give some guidance or comment on positive trends could be the ones that are benefiting from the stay-at-home sort of mentality.
Yeah, and I think it is a little bit of a tension between people realizing that these trends are kind of self-reinforcing. One of the reasons the obvious names like Amazon are benefiting is that people give credit to the company for retaining new customers. So in other words, once you're in the system, they're going to be able to keep selling to you. It's not clear to me that every company is in that category. So as we get more clarity on perhaps better reopening trends, if people gain confidence that the national kind of peak in case counts is really going to be sustainable, then you wonder if people are going to have another one of these rotations like we saw one that peaked in June. So that's the back and forth within the market, even as the overall indexes stay, reasonably well supported here near the top of their range.
I mean, we're watching Sherwin-Williams results crossing the tape right now, beating on both the top and the bottom lines handily. And this is one of these names that has just been a monster stock, Greg, and benefiting from this sort of trend of restoring your home. You notice that you need a coat of paint in your study, and you go out and you buy some paint, you paint it. And we're seeing that time and time again. Do you like this sort of trade?
Well, I'm going to harken back to the stay-at-home more generally. And if you don't mind, shift a little bit back to tech, because not all tech is created equal. When we look at how the group has traded, there are particular subsectors that have benefited more than others. And so when we look at the software and internet subsector, the relative performance there has been about 25%. When we look at the internet retailers, the relative outperformance there has been about 58%. And this is probably well-deserved. The internet retail space is expecting earnings growth of around 300% next year. But as we start to look at calendar year 2021, it's going to be a really tricky situation. Consensus is expecting many of these tech names outside of the internet retailers to be about 15%. But the broader market is expected to be around 35% as we see some of these depressed sectors start their recovery. And so what you'll have is very expensive names, in some cases 30% relative outperformance in valuation and margin expansion. So very expensive names trading at a super premium, but without the relative earnings growth outperformance to support those names. And so I think it's really key to differentiate between areas of tech. And as you rightly indicated, those that are positioned for the stay-at-home sector, I expect them to benefit in an outsized way.
Yeah, Thursday should be interesting. Alphabet, Amazon, and Apple all in one evening. Greg, nice to see you. Thank you, Mike Santoli.
As always,
Joe.
good to see you.